Raoul, in January, you tweeted, ETH equals BTC, like it or not. What do you mean by that? And how did you come to that conclusion?
Again, I'm a macro guy, so I don't have the engineering background that Lyn has, but how I approach this is I look at the attributes of how it trades as an asset. And what I did is I looked at estimations of network effects and said, well, do they look similar? And when you plot out Bitcoin's journey, its market cap or its price versus the number of active wallets, actually there's a nice clear regression line. And it happens after a certain period of time. So it gets to about 5 million wallets, and then it goes in a very clear, steep line, which is essentially an estimation of Metcalfe's law. And I found that Ethereum was exactly mirroring Bitcoin. When I say exactly, when I look at it on a plot graph with the same regression, it looks similar, but because it started later, it just follows Bitcoin earlier. But in fact, its adoption, i.e. the number of wallets at this time, is actually a faster rate of adoption than Bitcoin had. But what's super interesting is when you go back and match them from 1 million active wallet addresses each, their prices are identical and their price movements have been identical. And that took me by surprise. I didn't expect to see that because that normally doesn't happen. You have to fit the graphs, but it perfectly fits in every way. It's exactly currently in the 2017 run-up that Bitcoin had. And at exactly the same time, after it hit 1 million wallets, it gives you something similar. So that's when I say ETH equals Bitcoin, is because when you think of it in macro terms, they're both really network effects.
Okay, so Lyn, you have a totally different conclusion after writing like an extremely well-researched piece on all the ins and outs of Ethereum. So based on that extensive research, you concluded that you would not invest in Ethereum at this time. So what factors led you to that decision?
Yeah, so one thing I'd point out is I don't really view my position as opposite of Raoul. I actually think there's a ton of overlap. It's just not a perfect overlap. And the way I kind of look at it is, so for example, in the article, the overall conclusion is that I could see a non-zero allocation to Ethereum as making sense. And so I gave, for example, 80% Bitcoin, 20% Ethereum, or 90% Bitcoin, 10% Ethereum, or 100 to 0. I think there's still a case to kind of focus on Bitcoin, which is what I'm preferring to do. But I also point out that if Ethereum were to break over 1400, which now as of this recording it has, that's pretty bullish for the price action during a bull market in a broad sense. And so it's not necessarily that I'm bearish on the price in any kind of given 6 or 12 month period. It's more about outlining various pros and cons and then kind of sharing some of the concerns I had. And so I do agree that it is the really the one other protocol that does have a substantial network effect. And so that's pretty much undisputable because so many tokens run on Ethereum now. There's so much development happening on Ethereum. And so in my kind of mind, I think the big concern is to make sure in some ways we separate the growth of the ecosystem from the growth of price in the long term. And because you can be, for example, very bullish on the amount of value that's settled on Ethereum, the amount of smart contracts that happen on Ethereum, and then have a somewhat different view on what happens to actual Ethereum token appreciation over the long run when you include bullish and bearish cycles. And what I mean by that is, for example, if you look back during the 2017 high, since then, about 3 times as much value settles on Ethereum, and the market cap is still just roughly back to where it was. What you then argue is that therefore Ethereum's undervalued, and therefore that's kind of a bull case for Ethereum. A somewhat different view is, for people that aren't familiar, John Pfeffer wrote a paper back in late 2017, kind of highlighting this problem, and his argument was that the utility protocols, even if they are used for a lot of, kind of ecosystem GDP, you could call it, if they're used for a variety of things, that the value won't necessarily accrue to those tokens. Basically, you can have a high velocity, and that there basically might not be kind of a quote unquote moneyness associated with those tokens in the long term. It doesn't preclude those from being moneyness. If we see things like more and more collateralization of Ethereum, if you see a strong preference towards staking and kind of enough people wanted to hodl it as money, it can still become money. But basically, there's somewhat of a separate argument about the size of the ecosystem and the price of the tokens in the long run. Although I do agree, I think in many points that I can see why a lot of people want to have a position in Ethereum, And I can also see that it does so far have a substantial network effect. And I think one of the challenges going forward is how Ethereum is going to transition, because Bitcoin is, for the most part, a finished product. It's still evolving, just like any other finished product. Like they're still making updates to Adobe Photoshop, for example, but it's in like
and
the
Microsoft Word.
Exactly, but they're released things. Whereas Ethereum, because they're still doing radical changes to the underlying protocol, and they're, as they shift from Ethereum 1 to Ethereum 2, they go from proof of work to proof of stake. They're changing some of the dynamics because they're running into these scaling problems. Basically, there's just a lot more implementation risk, I think, and so you're kind of getting a higher risk investment. And I'm kind of open about whether or not it's higher reward, and that's why my preference was I can see why people like it, but that my view is I still like the risk reward of Bitcoin the best.
And so, Raoul, does that mean that you allocated 10 or 20%, like Lyn was saying she might do if she were to allocate?
So I started at 80-20. The Ethereum's gone up a lot more already. And then I allocated more. So I'm like 60-35. And then I went further out the risk curve and I bought a basket of alts as well. Equally weighted.
Which ones?
Well, I'm not going to say because because I don't want to make it like I'm pumping anything, because the alts world is a little bit wild and crazy. So I didn't want to do that. But basically what I took was I just looked at ones that looked like they were getting network effects. I asked people on Twitter. I got 6,500 responses. So I could figure out, okay, what looks like they've got network effect here. I look at the charts, and as long as they're a reasonable size market cap, I just took an equally weighted basket because I've no clue and I just don't have time to understand these in the depth that, we've all had to learn Bitcoin in, and we're all having to get up to speed with Ethereum in. So I did that because I know in the end, everybody does what I've done, which is they go further out the risk curve. They do it in emerging markets. So you might start with the EM ETF, which is a very simple way of getting emerging market exposure. Then you might get more India exposure because you kind of favor that and it works for your time preference. Think, okay, India, I can see that this is going to work for the next 10 years. And then as that trend starts developing, you start buying all sorts of frontier markets because everybody's piling in the risk curve. And the same happens in crypto.
And so you don't even know if they were like DeFi tokens.
I've got a mix from derivatives to DeFi to DEX. I mean, I purposely made a kind of relatively balanced basket. It wasn't a totally random process, but it was just some of that, to try and get an overall balance of the space. I wanted interoperability. I wanted, just different things, different protocols that allow smart contracts, and just got an overall basket of that.